Hi, welcome back. A single AI data center under construction right now will use more silver than an entire small country imports in a year. Not gold, not copper, as the headline story. Silver. And by the end of this video, you're going to understand exactly why $62 and $65 have become the two numbers every silver holder is quietly watching. Because the AI boom you keep hearing about on the news is connected to those levels in a way almost nobody is explaining clearly. If you own any silver, if you're thinking about buying some, or if you just have money sitting in a retirement account that touches mining or materials funds, this affects you more directly than you'd expect, and it has nothing to do with jewelry or coins. Here's what's actually happening right now in 2026, while most people are focused on chips and processors. Every AI server rack, every high-speed switch, every piece of equipment inside these massive data centers depends on silver. Because silver is still the best conductor of electricity on the planet, copper is good. Gold is stable. But when speed and efficiency actually matter, at the scale these companies are building, silver is what gets used in the connectors, the printed circuit boards, and the thermal management systems that keep these machines from overheating. And these facilities are not being built one at a time anymore. They're being built in clusters, funded by some of the largest technology companies in the world. And each one needs more silver than the last generation of data centers ever did. So what does that tell us? It tells us that silver isn't just a precious metal story anymore. It's becoming an industrial backbone story. And industrial backbone stories move differently than jewelry demand or coin collecting ever did. Let's break this down because the mechanics here matter more than the headline. For decades, silver demand was split fairly predictably between jewelry, silverware, coins and bars, and industrial use. Things like electronics, solar panels, and medical equipment. Industrial use has always been meaningful, but it grew slowly in a way that mining companies could plan around. What's happening with AI infrastructure is different. It's not a slow, predictable curve. It's a sudden, steep increase in demand from an industry that barely existed at this scale 5 years ago. Data center construction tied to artificial intelligence has accelerated so quickly that supply chains built for the old pace of demand are struggling to keep up. Now here's the part most people are missing entirely. Silver mining doesn't work like flipping a switch. You can't just decide to mine more silver because a new industry suddenly wants it. Roughly 70% of the world's silver doesn't even come from silver mines. It comes as a byproduct of mining for other metals like copper, zinc, and lead. That means silver supply is tied to decisions made in completely unrelated industries. If a copper mine slows production because copper prices are soft, the silver that would have come out of that same mine slows down too, even if silver demand is exploding. It's a strange, almost hidden bottleneck that most new investors never learn about. Think about it this way. Imagine a bakery that makes bread, and as a byproduct of that process, it also happens to produce a small amount of a specialty flour that a completely different industry desperately needs. If the bakery decides to make less bread because bread prices dropped, that specialty flour becomes scarce too, even though demand for the flour never went down at all. That's roughly the relationship between base metal mining and silver supply right now. The AI industry doesn't control silver mining decisions, and silver mining decisions were never designed around AI's growth curve. Here's another layer most explainers skip entirely. It's not just the sheer volume of silver these data centers use, it's where that silver goes once it's inside the equipment. High-performance AI chips generate enormous amounts of heat, far more than a typical server did even a few years ago, and the connections carrying electrical signals between components need to be as efficient as possible, or the whole system loses performance to resistance and heat loss. Engineers have tried substituting other materials in some of these applications over the years, and silver keeps winning on performance, even though it costs more than copper. When a company is spending tens of billions of dollars on a single data center campus, the extra cost of silver in the wiring and connectors is a rounding error compared to the performance gains it provides. That trade-off, multiplied across hundreds of new facilities being built worldwide, is exactly why silver demand tied to this sector has grown so much faster than most forecasts predicted even 2 or 3 years ago. Now pause for a second and think about how fast this has happened. As recently as the early 2020s, artificial intelligence infrastructure barely registered as a category in silver demand reports. It was a rounding error next to solar panels, electronics, and traditional industrial uses. Fast forward to now, and some industry analysts tracking silver consumption have flagged AI-related data center build-out as one of the fastest-growing demand categories they've ever measured. That's not a slow multi-decade trend playing out quietly in the background. That's a demand shift compressed into just a few years, hitting a supply chain that, as we just covered, can't easily expand to meet it. This is where we start connecting the dots on 62 and 65. As global silver inventories have tightened, and we've seen registered inventories on major exchanges shrink over the past couple of years, the market has started pricing in scarcity that used to be purely theoretical. $62 has acted as a psychological and technical ceiling in recent trading, a level where sellers have repeatedly stepped in. 65 sits just above it, and traders watching the charts know that a decisive, sustained move above both of those levels would signal something different. Not just a speculative spike, but a market acknowledging that real, structural demand is outpacing real structural supply. But here's the part that deserves a pause, because it's easy to get swept up in a story like this. None of this guarantees silver goes straight up in a straight line. Markets almost never work that way, and anyone telling you a specific price is certain is skipping over a lot of uncertainty that's very real. AI data center construction could slow if financing conditions tighten, or if some of these massive projects get delayed, which does happen. Recycling technology is also improving, and a meaningful amount of silver used in electronics can eventually be reclaimed and reused, which puts a ceiling on how tight supply can actually get over time. Acknowledging that isn't pessimism. It's just being honest about how commodity markets actually behave. But here's the part that's easy to overlook when you're only reading headlines about AI spending. Even recycling has limits in this specific case. Recovering silver from a solar panel or a piece of jewelry is relatively well established. Recovering silver from the microscopic connections inside a data center server embedded in tiny quantities across thousands of components is a much harder and more expensive process, and it's not happening anywhere near fast enough yet to offset the new demand. So while recycling absolutely matters as a long-term pressure valve, it's not the quick fix some people assume it is, at least not for this particular corner of silver's industrial story. That's worth sitting with for a moment, because it's exactly the kind of detail that gets lost between the simplified version of this story and what's actually happening on the ground. Let's go back to your money for a second, because that's really what this is about. If you hold physical silver ETFs, or shares in mining companies, this AI-driven industrial demand is one more layer of support underneath the price, a layer that didn't really exist in a meaningful way 10 years ago. If you don't own any silver at all, understanding this dynamic still matters, because it explains why silver has behaved less like a sleepy inflation hedge lately and more like a metal caught between two worlds, part monetary asset, part critical industrial input that a booming technology sector genuinely can't function without. It's worth being honest about the emotional side of this too. Watching a market you're invested in swing between excitement and doubt can be uncomfortable, especially when the headlines keep shifting between silver shortage and silver correction within the same month. That back and forth is normal for a metal caught in the middle of two powerful, sometimes conflicting forces, traditional safe haven buying on one side and this newer industrial story on the other. You don't need to have strong conviction about exactly where silver goes next to still find it useful to understand why it's moving the way it is. Curiosity, not certainty, is really the healthiest way to approach a market like this one. And that's really the mental framework worth taking away from this whole conversation. Stop thinking of silver as one thing. Think of it as two overlapping stories happening at the same time. Story one is the traditional one, silver as a store of value, something people buy when they're worried about currency debasement or economic uncertainty, similar to gold but historically more volatile. Story two is newer and, frankly, less talked about. Silver as an industrial necessity for the technologies reshaping the global economy, from solar panels to electric vehicles to now, increasingly, artificial intelligence infrastructure. When both of those stories are pulling in the same direction at once, which is roughly what's happening right now, that's historically when silver has made some of its sharpest moves. When they pull in opposite directions, the price can stay range-bound for a long time, frustrating people who expected a straight shot higher. If this kind of breakdown is actually useful to you, it helps a lot to hit subscribe, so these deeper dives keep showing up when they matter. And let's keep going, because there's more nuance here worth understanding. So where does this leave us looking forward? There are a few reasonable paths this could take, and it's worth sitting with all of them instead of picking a favorite. One path is that AI infrastructure spending continues at its current pace, or accelerates further. Industrial silver demand keeps climbing, and combined with already tight above-ground inventories, silver pushes decisively through 62 and tests 65 and beyond, with the metal increasingly treated by institutional investors as a strategic industrial holding rather than just a monetary one. Another path is more measured. AI spending normalizes to a steadier growth rate rather than the explosive pace we've seen. Recycling and efficiency improvements ease some of the supply pressure, and silver trades in a wide range between the 50s and mid-60s for an extended stretch while the market digests all of this. A third path involves a broader economic slowdown, which historically has hurt industrial demand for silver, even while monetary demand for precious metals as a whole sometimes rises, creating a genuinely mixed and harder-to-predict picture. None of these paths is a prediction. They're simply the honest range of what's plausible given what we know today. Now let's finally close the loop we opened at the very beginning. 62 and 65 aren't magic numbers pulled out of thin air. They're the visible price levels where an invisible supply and demand story is being tested in real time. Every time silver approaches 62, it's effectively asking the market a question. Is this AI-driven industrial demand real and durable enough to absorb higher prices, or will supply, recycling, and slower than expected data center buildouts cap it here again like they have before? A sustained break above 65 would be the market's way of answering that question with a fairly clear yes. Staying capped below 62 would suggest the story, while real hasn't yet overwhelmed the supply side enough to force a lasting breakout. What does this mean for your actual money and decisions beyond just watching a chart? It means the old mental model, silver moves mainly because of inflation fears or geopolitical anxiety, is incomplete for 2026 and beyond. If you're evaluating silver as part of a diversified approach to savings or retirement planning, industrial demand tied to AI, electric vehicles, and renewable energy infrastructure deserves a place in that evaluation right alongside the traditional monetary case. That doesn't mean silver is risk-free or guaranteed to rise. It means the reasons someone might hold it have quietly expanded, and understanding that expansion helps you make sense of price moves that might otherwise seem confusing or random. Before we wrap up, it's worth remembering that none of this happens in isolation. Silver doesn't move independently from the dollar, from interest rates, from what's happening with gold, or from broader risk appetite across financial markets. The AI data center story is a genuinely important new thread in the silver narrative, but it's one thread among several, not the entire fabric. Anyone who tells you it's the single reason silver will or won't do something specific is oversimplifying a market that's always been shaped by multiple forces pulling at once. So here's where we leave things today. The AI industry's hunger for silver is real, it's growing, and it's reshaping how serious investors think about this metal heading into the back half of 2026. Whether that translates into a decisive move through 62 and 65 or a longer, choppier consolidation, while the market figures out how durable this demand really is, comes down to factors we'll be watching closely in the weeks ahead, including upcoming data center announcements, mining supply reports, and how central banks and industrial buyers are positioning around this metal right now. That's exactly what we're going to dig into next, because there's a specific supply report quietly circulating among institutional traders that could change this picture faster than most people expect. And you're going to want to understand it before the broader market catches on. I'll see you in the next one.